All right, top of the morning. I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot. The opening bells on Wall Street on this busy earnings Tuesday morning. Walmart ringing the bell at the New York Stock Exchange. Touchstone Investments getting things popping over at the NASDAQ. Now, earnings fest is officially underway. Surely you're still assessing. Brief comments from Fed Chair Jerome Powell this morning, mostly on bank regulation, which come during the Fed's blackout period, and a fresh attack from Treasury Secretary Bessent. And yes, markets are hovering around new records on the back of enthused retail investors, but mixed earnings from General Motors and Coca-Cola this morning shed light on the challenges corporate America is having thanks to the Trump administration's trade war. That could be the tone setter for today's session. Now, of course, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all of that money in your portfolio. I know you have. Let's see what's hot in the markets this morning. Yahoo Finance senior reporter Callie is live from the NASDAQ in Times Square for us. Callie.
Hi, Brian. Well, we're seeing markets open pretty much flat across the board here. The Dow is down, let's call it 0.1%, just around 35 points. The NASDAQ pretty much trading flat to the upside, same with the S&P 500. So the major index is not doing too much today, but we do have some individual movers as earnings season kicks into high gear here. I have my eye on Coca-Cola. We are seeing shares open down 1.5%. Now, this comes after the company did say that the consumer remains resilient. They said they will be rolling out cane sugar. That's going to be an and, not an or, when it comes to their product lineup. And really, the resiliency of the consumer is something we're going to continue to track all earnings season as these companies come out with their reports. How are buyers continuing to spend in this environment where inflation still remains sticky, and we do have, at least for now, this higher for longer interest rate policy from the Federal Reserve? I also have my eye on General Motors. We are down about 3.5% at this point. This is a company that also reported earnings this morning. They did take a $1.1 billion tariff-related hit in the second quarter, and they said the tariff impact in the current quarter is going to be even worse. So we're seeing how some of these tariffs are trickling through into corporate profits, weighing on the bottom lines, and the auto industry especially has been exposed to this. And then finally, I want to take a look at DJT, Trump Media and Technology Group. The company said it purchased $2 billion in Bitcoin and related securities yesterday. You're seeing shares up another 3.5% today. Now, with those purchases, Trump Media, which is the parent company of Truth Social, that's a social media platform that President Trump frequently posts on, the exposure to Bitcoin there for Trump Media now compromises 2/3 of its overall assets of around $3 billion. So again, not doing much on the majors here, Brian, especially as investors are continuing to track a lot of headlines on the trade front. Secretary Bessent said the U.S. is going to be restarting those talks with China, but at least for now, we're not seeing too much of a reaction here.
A look at a new conglomerate in DJT. Thanks, Callie. We're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, the bull thesis in General Motors springs a leak. GM easily beat second quarter profit estimates and touted triple-digit sales growth in its EV business, but its reaffirmed profit outlook is causing some concern amongst investors. GM warned that second half volume will be lower than the first half, and it sees a $4 billion to $5 billion profit impact from Trump tariffs for the full year. In the second quarter, it realized a $1.1 billion profit hit. Number two, Coca-Cola loses some fizz. Similar to GM, Coca-Cola easily beat analyst profit estimates for the second quarter, but also similar to GM, Coke investors wanted more meat on the bone, or fizz in the drink, so to speak. Areas of concern in Coke's report include only slightly raising full-year EPS guidance and soft volume in the key North America market. Number three, retail investor euphoria spills back into meme stocks. Record-setting markets have renewed retail investor appetite for meme stocks. I continue to track wild moves in Opendoor. At one point on Monday, the stock gained 115%. It finished the session up 42%. Shares are up by double digits in the early going today. Investors also appear to be engaged with other meme names at Beyond Meat and GameStop. Barclays estimates that retail investors have poured more than $50 billion into global equities over the last month, mostly via global developed market funds. Let's pull up our roundtable for today. Callie Cox, Ritholz Wealth Management Chief Market Strategist, Eric Freeman, U.S. Bank Asset Management Group Chief Investment Officer, and Yahoo Finance Senior Reporter Callie is with us from the NASDAQ. Callie, I want to go to you. You've been out there posting on X the past few hours, which I'm always tracking. Explain to me why, when we see a General Motors say we're going to see a potential profit hit this year of about $5 billion from Trump tariffs, why this market isn't down and not down a lot more?
That's a great question, because if you think about General Motors and automakers in general, I mean, that's the poster child for tariff impacts, right? Automakers are one of the most globally exposed sectors out there, especially to the nearshoring, especially the Mexican and Canadian factories out there. So I'm a little perplexed by that. I think the market is trying to digest where we are and how quick this tariff hit will be. And I guess what it's telling us is that this tariff hit could be a few quarters and that's it. And honestly, that's what GM is telling us as well. So I feel like markets are looking a bit further into the future.
Eric, don't these, well, good to see you, Eric. Don't these numbers from General Motors, and I know Coca-Cola didn't call it out, but just as someone that has covered Coca-Cola for a long time, I go through that earnings release, and I think I could see areas of their business impacted by tariffs or geopolitical tensions. Is it time for investors to pay more respect to the headlines on tariffs, especially as we come up against the August 1st deadline?
Yeah, I think it's something that is obviously, it's not really that perplexing in terms of what's happening with tariff and tariff policy, just in the idea of this is a very fluid situation, and pricing for any company is very much a prisoner's dilemma. I mean, this is an environment where, if you think about the two great capital allocators of Charlie Munger and Warren Buffett, they had a hard pile of decisions and an easy pile of decisions. Anything tariff related right now goes into the hard pile because there just isn't a lot of clarity in terms of where we're going. And until there is country by country, industry by industry clarity, it's really just a matter of investors giving a bit of a hall pass, if you will, with respect to tariff policies. So if you're Coca-Cola, if you're General Motors, this is an environment where you're obviously looking over your shoulder, looking at what peers are doing, but you're also really needing to have more clarity from Washington. So I do think investors, really large investors like us, are thinking about, we probably have another couple of weeks, if you will, of back and forth. And once we get that clarity, that's where the prisoner's dilemma becomes a bit clearer. So I think this is an environment where investors are recognizing there are some things that we can forecast. There are some things that are, again, we're more price takers of. Tariff policy is definitely in the hard pile, definitely in the price taker camp right now.
Callie, when you talk to your clients, have they not written off 2025, but have they started to or begun to focus on 2026 and the profit potential for companies?
They haven't necessarily written off 2025, first of all. I mean, we've seen an incredible rally from the mid-April lows, and I think investors and at least clients of Ritholz have that in the back of their minds. And we constantly remind them, I mean, this is the reason why you stay invested, because things did look bleak in the middle of April, but sentiment, not earnings or economic fundamentals, drove this market higher. And it just goes to show you that it's hard to market time. But, our investors are long-term investors. They're looking a decade or decades out into the future. So in a way, they are thinking about 2026 and what will happen there. But for now, they're encouraged by the market rally. They're curious about tariffs. They're curious about policy. And they're wondering how they can adjust their financial plans to fit all these moving pieces.
Allie, your take on what we saw from General Motors this morning?
Yeah, I think I echo what the panel said. General Motors, the car companies in general, they are most exposed to these tariffs, and we are seeing that directly hit the bottom line. I thought it was interesting that they are trying to offset that impact by investing billions into U.S. assembly plants, so trying to insulate themselves as much as they can from these tariffs. But I think what we've seen from earnings calls so far, and earnings season so far, is this message of consumer resiliency. And I think back to Coca-Cola and what they said, how the consumer remains strong. They're trying to cater to that lower income cohort of folks as well. And that's something that I've been wondering if we're going to continue to see this greater bifurcation between higher income consumer and lower income consumers. Now, Coke saying that they plan to take on as many of the price increases from tariffs as they can. And when you look at inflation across the board, we recently got the consumer price index. We are seeing inflation start to show up in some products out there like apparel, footwear, furniture, but it's not at an aggressive level that economists have previously been warning about. That doesn't mean, though, that it's not coming down the pipeline. And I think the fact that you're starting to see this show up and be more of a talking point in these earnings calls is perhaps a precursor for that really showing up on the consumer side down the line.
Eric, one thing that stood out to me from these Coke earnings, of course, despite them confirming full sugar cane soda as if we need more of that stuff in our lives. I mean, just drink some water. But what stood out to me was North America volumes down 1%, but the operating profits in that division up 10% as Coke lifted prices. Is that one thing investors are missing? That corporate America, yeah, we have tariffs, cost of doing business are higher, but they are just being able to withstand all of these cost pressures and dump more costs onto the consumer to boost their profits.
Yeah, I think if you look at it on a company by company basis, which you really have to, I mean, Coca-Cola has 45% market share globally speaking in carbonated beverages. They have 5 of the top 10 brands. So they're a company that can certainly pass through cost to consumers. If you look at other companies that have been quite vocal, whether that's been Home Depot, whether that's components of Walmart, or even some of the back and forth with other retailers. I think the point made a minute ago about the divergence between higher income and middle income and higher and lower income consumers is significant. That is what we're seeing in a very, very nuanced consumer market. This is a hyper promotional environment to get people, especially lower income and lower middle income consumers, to spend money. You have to be out promoting. You have to be out with deals. And so, not to hit microeconomics on a Tuesday morning, but price elasticity is significant. In terms of the willingness to consume, we're at that point of the cycle where consumers have had really high prices for some time. Mortgage costs, rental costs, transportation costs, et cetera. Those aren't necessarily abating. And so this is a cumulative impact. And in a cumulative impact, you start to see things slow down. So for right now, before we have that tariff clarity, seeing those companies that do have pricing power actually through results like we saw from Coca-Cola, those are certainly important things to pay attention to.
Callie, I think you'll be a good person just to level set what's going on here in the meme stock. So we're seeing activity in Beyond Meat, GameStop, but it's really, I've been tracking these moves in Opendoor, which are just totally wild. What do you tell folks that are in a stock like Opendoor, trading in and out of this frenzy of a company that, barely makes anything?
Well, first of all, I want to know why I'm the one to level set on meme stocks.
Well, you always have to, you focus on valuation, you're the long-term minded investor. Just bring clarity to these folks out there on the Yahoo Finance platform bidding up these stocks. I mean, this is wild stuff and really came out of the blue.
Yeah, and I was just kidding about that. But meme stocks, look, the phenomenon of meme stocks isn't going away. I feel like the genie's out of the bottle. And it's just become a way for a certain subset of everyday investors to trade. And that's completely fine. It's your money. You do whatever you want with it. If you're trading these meme stocks, if you have a little bit of cash on the side, I mean, what I'll say as a side note, what we've seen is that investors do still have a lot of cash on the sidelines. So does it surprise me that more speculative mania is creeping into markets? No, and I don't think you can say when the froth is too much or not. You can only call a bubble in hindsight, so I'm not going to do that. But if you are trading these meme stocks, if you were one of the investors in Opendoor yesterday during its wild ride, just remember to set your targets. Understand why you're investing in Opendoor, and really, again, going back to the targets, really understand where you're getting in and where you need to get out.
Callie, I was actually going to ask you if you were down with the full sugar Coke. I mean, that's what I had written down. But we're on live TV.
Do you love a good Coke?
Yeah. I suppose. Ali, last word to you real quick. These moves in these meme stocks, I think back to when we all cover here Yahoo Finance, the original OG meme stock move. Now, this isn't quite the same, but it's extreme and it's something we haven't seen in a while.
Yeah, and I think that's why it's a big talking point on Wall Street right now, if we are at levels that are too frothy. But most strategists that I talk to say we're not there yet, and that's because the market is pretty healthy right now. We have, obviously, tech leading the way higher, trading at record highs, but we've also seen this breadth across other sectors as well. Financials, communication services, industrials, they are also at records, and that's a sign of a healthy bull market. Now, July is typically the quietest month for stocks on a seasonality basis. Usually in August and October, you see a bit more choppiness. And I think with the Fed policy still unknown, the tariff unknowns coming up August 1st, hopefully we get a little bit more clarity there. It's likely that we're going to see some volatility, but we just saw another record close for the S&P 500 and the NASDAQ. There's a lot of optimism in this market. Strategists are chasing their price targets. They're continuing to raise those year-end targets. I think we're going to see a few more raises before we get to the end of 2025. But of course, you have to wade through earnings season and all this volatility as well. So on the meme trade, I agree with Callie. I'm not totally surprised to see this happening right now. There's a lot of optimism, it seems, within stocks at this point, but that doesn't mean that the fundamental side isn't doing well, because it is, and that's really what's holding this market higher.
True that. Straight ahead, the bulls are doubling down on Microsoft into earnings, and as for our stock of the day, let me just say it's the complete opposite of a bullish story. We'll be right back. Welcome back to Opening Bid. Microsoft is set to report earnings on July 30th, and the bulls are wasting no time doubling down on the name into the print. Citi analyst Tyler Radke is out today hinting Microsoft will announce big numbers from its Azure cloud business. He expects Wall Street consensus forecast to reset much higher after the earnings report. Radke's $613 price target assumes 20% upside from current price levels. All right, let's fire up our stock of the day, struggling Intel, with an emphasis on struggling. Saying Intel is expected to report an ugly quarter after the close on Thursday would be an understatement. The company is barely expected to be profitable as new CEO Lip-Bu Tan begins to restructure the tech giant. This at the same time Intel is hemorrhaging market share to rivals AMD and NVIDIA. In many respects, Intel isn't even in the AI chip discussion, and the lack of belief in Intel is seen in the earnings estimates found on the Yahoo Finance platform. Earnings estimates for 2025 and 2026 have plunged compared to 90 days ago. A majority of the analysts on Wall Street rate Intel stock at a hold or a sell. No buys. Here's what investors are yearning to hear from Lip-Bu Tan on his second earnings call since taking over for Pat Gelsinger as CEO in March. First, how bad is the commentary on medium and long-term guidance, as Intel is barely playing in the AI revolution? Two, how committed to making chips for other companies is Intel in an age of Taiwan semiconductor dominance? And three, what other non-core assets can be sold off to ease cost pressures on Intel? Still with me, my roundtable, Callie Cox from Ritholz Wealth Management, Eric Friedman from U.S. Bank Asset Management Group, and our very own Ali Cannell. Eric, let me get this one over to you. Does Intel's report serve as any barometer for the tech trade more broadly, or this is a company on its last legs that needs to make really major moves to regain the trust of investors?
Yeah, it's an important barometer. I think first and foremost, we have to step back and look at the chips market writ large. I mean, we've got right now a total addressable market of about $630 billion, which is significant. That actually jumps to 2030 up to $1 trillion. So they're obviously in a space that is at least rising several boats. If their boat will rise, of course, we'll learn a lot more in the next couple of days. But I think there are a couple of things to keep in mind. Number one is that there is a real divergence within chips. You've got graphical processing units, GPUs, versus central processing units, CPUs. CPUs are actually subject to an upgrade cycle to really allow devices to run AI software. Without question, companies like NVIDIA are making a ton of strides in GPUs, but the likes of an AMD or an Intel do have the opportunity to participate in that upgrade cycle. So I think understanding just how, in fact, real that total addressable market is will be important. The second thing, as we know, is that AI remains a constrained technology. It's just difficult to get a lot of that technology across all of the potential landing points for it. And so the DeepSeek news actually has made it, in fact, a bit more of a transformative technology. So how Intel, how AMD, and how other companies are able to help transmit speed to market, we think will be an important barometer. So a very important report for us to gauge what's happening in tech as well as what's happening in semis specifically.
Callie, is Intel of any relevance to you?
Well, we don't pick single stocks at Ritholz, but the biggest tech companies on the market and tech's progress in general, of course, is of utmost importance to us. If you think about tech, at least the Magnificent Seven making up about 30% of the S&P 500. And look, we're watching global wins, global trade wins. We're watching global catalysts, and I think the semiconductor industry is one of the best places to look to get a sense of those global trade wins. Intel is hard. You have to separate the Intel specific color from the macro color. We'll be watching the macro color a little bit more, but I don't think you can look at Intel and make an argument that it doesn't have its own issues to fix here. What I'm watching, though, especially because Intel is one of the first semiconductors to report, is, again, how much global relationships have suffered under tariffs, what they see for the year ahead, their own issues, and really, setting the stage for what we can expect for the rest of the semiconductor reporters, which will come later this season.
Callie, what's bonkers to me? We're talking about what assets Intel can sell, and every day we're talking about how much higher the market cap can go on NVIDIA because of what it already sells.
Right, and there's this juxtaposition, right, between Intel and a lot of these other big AI plays. But I was talking to one of our reporters, Laura Bratton. She has a great piece out on what this make or break moment means for Intel, and it really relies on this new chip-making process called 18A, and this is what Wall Street sees as a last real shot for Intel to take that semiconductor crown away from TSMC. 18A is set to launch later this year, and it has two advanced techniques that TSMC hasn't yet adopted, and that's going to lead to more efficient chips. At least that's the promise there. Now, Intel's new CEO, he has been praised for more clarity on where the company's at, accepting the challenges and moving forward with that, but they do say that the company must execute on 18A in order to prove that it's in a solid spot. So there's just a lot of question marks around this company. I will say the stock is up about 16% since the start of the year, still down about 30% on a year-over-year basis. So you have to separate it from the rest of big tech, but perhaps this is a big moment for Intel to show that it can execute on a lot of the promises that they've made previously.
Fine, I guess Intel's still relevant, guys. You convinced me. All right, it's time now for our question of the day. Big tech earnings getting starting this week, as we have been talking about here. Are these stocks priced for disappointment? Clearly, Intel's not. I mean, the stock has been hammered. Eric, let me go over to you here. How good do these tech companies have to report? Now, I'm looking at Coke and General Motors today. Both of them really thumped analyst profit estimates. Stocks are not really reacting as you would think off of beats. Does that read anything? Do you read anything into that as we head into big tech earnings?
I think if you look at big tech, the key for all of these companies, the one common thread, if you will, is what happens with CapEx. And back to the earlier segment, we were talking about companies making hard pile and easy pile decisions. CapEx is a very hard pile decision right now. So to the extent that you have, I think the mix shift, which we think still will be very prevalent for any company that has a large budget, which is they have to spend on technology, cyber, big data, AI, those are necessary expenditures to keep up with peers and hopefully in some cases get ahead. So for us, it's not really a question of mix, it's just a question of the amount. And one of the things we have seen consistently, the holdback, if you will, from last quarter on guidance has spilled over somewhat into this quarter as well. We're not getting as clear guidance on CapEx, which of course is important. The other thing that I'd also emphasize is the notion of the upgrade and refit cycle, which is still early days. We have a depreciation schedule now in the tax bill, which actually does favor some capital expenditures, but whether or not companies are willing to make that leap, we think will be important. So I think it's not so much about mix as it is about the amount. So again, we do think there is a lot of good news already priced in, but we're still buyers, we're still believers in technology, so we would not be, taking the other side of that at this point in time.
Callie, what are these large tech companies? What do they need to do to impress you as you're reading the earnings releases?
Well, they need to do a lot because earnings expectations are quite high this time around, and they have been. And to tech's credit, especially bigger tech companies have been consistently beating that bar. But something I find interesting is that tech is one of the most globally exposed sectors, both by international revenue standards and by cost of goods standards. Yet earnings expectations for the year have basically stayed the same, even though you've seen expectations on other tariff-affected sectors like retailers, like industrials, like materials, come down a good bit since March or so. So, I mean, tech is a compelling space. I think it's hard to make the argument that AI is not the story that everybody makes it out to be. But I think what's hard, and bringing in what Eric said about CapEx as well, is that, margins might be tougher to maintain for these bigger tech companies, especially if they're spending hundreds of billions of dollars on CapEx. And I'm not sure how they're going to thread that needle when these reports come out. Of course, this is a short-term concern. Again, I think tech is the leading sector for a reason. But right now, especially if you're looking over the next 3 to 6 months, we think it makes sense to maybe cull back on some of those profits on the tech side of your portfolio.
Bring on those earnings reports. I'm ready. Callie's ready. Eric's ready. I know Allie's ready. She's going to be covering here for Yahoo Finance. Big thank you to my roundtable. Good to see you all. Appreciate it. All right, the trading day is underway, and in financial markets, every second matters. What you do today could determine your financial future. So my final thought is this, folks. The market is at records, embracing the narrative that Trump tariffs aren't a big deal to corporate America. However, General Motors told you today that tariffs are a big deal. Others have done the same early on in this earnings season. The time could be near to fade this rally as the August 1st tariff deadline nears, as it raises the risk of tariffs being more of a big deal to the bottom line this year. Coming up, Yahoo Finance's Market Catalyst, we bring you the news behind the market moves for the trading day. Do stick around.